All right, so today I want to take you guys into a deep dive into my worst investment ever. It's caused me to lose over 100,000 US dollars in the past year. Now I want to keep it real with you guys on this channel. This is not always just my successes and the wins and how much money I've made on this particular investment. Sometimes you win, sometimes you lose. And this instance, it was definitely a huge loss. What I'm hoping to do with this video is to show you guys some of the mistakes that I made and help you learn from my mistakes so that you don't make the same ones that I did. Now, being that this year is coming to a close and I'm doing some reflecting on the decisions that I've made over the past year. Obviously, this $100,000 investment failure is a big one and something that I've definitely thought about quite a bit. And I wanted some closure on this topic, and I'm probably not going to try to think about it a whole lot in the future. So making this video is sort of my way to document what that journey was, some of the mistakes that I made, so that you guys can learn from those and then move on from here and be in a much better place moving forward into next year. Now, for those of you guys out there that have been following my channel, you would know that I only graduated college a couple of years ago, and to stomach a $100,000 loss at my current age with the amount of money that I'm making, regardless of whatever that is pretty tough, and honestly something that is kind of hard to wrap my head around just because of the mistakes that were made and things that I could have done in the past to avoid this. But honestly, I'm not the type of guy to dwell in the past, and I don't really like to think about the I should have or you should have done this and done that. I really don't like when I hear people talking about, oh, you should have done this in the past, or oh, you should have or could have done this. And you know what? That didn't happen. So we're gonna move on with the decisions that were made to actually execute a better plan in the future and not make those same mistakes. Now, in reflecting on this investment mistake, if there's anything good that I think can come out of this and pulling some of the positive out of this negative situation, I think it's that I'm grateful that I'm experiencing this now and hitting this huge roadblock or this failure or whatever you want to call it now, instead of maybe 5 or 10 years from now when I've got a family, I've got kids, you got to put food in their mouths. And right now, I think it's not necessarily a good time for this to happen. It would be better if this had never happened. But if anything, I'm happy that I'm experiencing it now, so I've learned the lessons and can move on to better things. So to break it down for you guys, you probably know what I'm already talking about if you follow my channel, and that's my condo in San Francisco that I've been talking about for the past year. And a year ago this time, when I made a video about this real estate investment, I was hoping that at this point this year, I'd be able to share with you guys how well it went and the investment decisions that were made with the contractors and the property, the type of selections of different materials that turned quite a profit. But apparently those numbers didn't exactly work out. And some of the initial risks that I took that I thought I could mitigate and manage actually turned out to be a lot bigger than I thought. So here we are today with a net gross margin of over negative $100,000. And I'm going to explain to you guys in depth today how that process went, both the financial breakdown as well as before and after of how the condo went from what it was when I first bought it to what it is today, as well as some of the investing decisions and things that I could have done better to mitigate some of those problems, and so you guys can avoid some of the mistakes that I made. So the first thing I want to touch on actually is more of a macroeconomic trend, if you want to call it that, and things that you can't actually influence that have a big impact, especially on flipping properties in terms of real estate investing. So as some of you out there are probably experienced already, the large majority of investing that's done in the short term is very risky, and the majority of the time, long-term investing strategies are going to prevail over a short-term strategy. Now, especially with regards to housing, right? The housing market and interest rates that are determined by the Federal Reserve. Rates reached an all-time low last year in 2021, and due to rising inflation, the Federal Reserve decided that this year was the year they're going to rapidly increase those rates in order to combat inflation and try to bring that number down. Now, you might be thinking, as an investor, it doesn't really matter to you what the rates are as long as you have a deal that's actually structured correctly and you run the numbers and the numbers work so that your exit margin is enough so you have a buffer in case, for whatever reason, the place doesn't sell. Now, the problem with that is that investing in real estate, especially with a flip, is very different than investing in another asset class, let's say, broad market index funds or ETFs, where you can purchase and sell them at any given time as long as it's not a holiday and the market is open. Now, with real estate, you get the added factor of supply and demand. So you can't necessarily just sell a place for market value just because you feel like it. With a publicly traded company, you can sell the stock for exactly what it's worth on that given trading day on whatever platform you feel like. If you want to sell your house today, well, you have to line up a buyer that actually wants to purchase your property and then make that sale happen. With rates going up as quickly as they did, it definitely affected the market significantly, especially in San Francisco, since so many people had already left that city. The demand really wasn't there, especially for condos. And so all these things were things I should have definitely considered before purchasing the property in the first place. But I do want to say that if I've learned anything from this entire process, it's probably that flipping real estate is extremely risky, especially because you cannot predict interest rates and where the market's going to be even 6 months from now. It can totally shift in the matter of a few months, and that could affect whether or not your ARV is accurate or not. Now that we've gotten that out of the way, let's break down exactly how I got this deal, how it was structured, what the hopes were for the target ARV, the maximum amount for the rehab budget, and then the numbers of actually how it turned out with the amount that I spent on the rehab, the holding costs, the HOA fees, all the change orders, everything that went into the deal that affected how much we were able to sell it for and where I'm at today. So this was earlier last year when I was looking for an investment property, and I thought for whatever reason it would be a nice idea to have a place in San Francisco or in the Bay Area, since that's somewhere I have to travel for work quite a bit. So in the event I wasn't able to rent it out, I could actually just live there and stay there when I was in the Bay Area. And so I thought overall it seemed like a good place to purchase an investment property, especially if I was able to find an off-market deal. So I was able to network and find my realtor, and she was able to find me an off-market deal that seemed to be pretty good at the time, especially with the way the comps had sold in the same area, in the same building, that recently sold for much higher than what our target ARV was going to be at the time. So this was late last year when I first initially purchased the property, and the target ARV was somewhere around $750,000. I initially purchased the place or an agreed purchase price off market for $630,000. Now I get this is not within the 10% rule or the 15% rule or whatever margin rule you want to use. This does not fall under that because the margin for the deal was already super tight from the beginning, and so it's going to be pretty tough to squeeze a profit out of this one. Nonetheless, I had a contact for a contractor, and I knew that the comps had just recently sold for much higher than the target ARV, so I had no issues with putting in the work to make this happen and put it back on the market in just maybe 2 or 3 months. I think I thought at the time, because it was a 1-bed, 1-bath, it's a unit that's pretty small. It was easy to do the renovation, it was easy to get it approved, and there'd be no issues and no roadblocks really to get the work done. Just because of the unit size, it would be pretty quick to get the rehab done and then just put it back on the market. Unfortunately for me, I was very mistaken. For the purpose of this video, I'm gonna go ahead and show you guys some of the before photos so you can just see what it looked like before I actually did the rehab. And so it was mostly a cosmetic rehab. Because it's a condo, all you have to worry about is the interior of your own unit. And so there's a lot of restrictions that go into the actual work that can be done. And that's what I'm gonna get into a little bit later, which is the HOA approvals for actually getting this work done in my unit with this condo. Now again, this place is very outdated, probably not been renovated for maybe 10, 20 years at the least. And it definitely needed some work, but it was nothing too serious that I couldn't find a contractor to get the work done. There's nothing structural because again, the building is insured and covered by the condo HOA, and that was not part of my concern. It was mainly just the interior cosmetics of the unit and making it way nicer than it was ready for rent or for sale. Now again, I wanna make it abundantly clear that when you have a very tight margin with the deal, you have a very risky deal. Okay, regardless of how quickly the comps sold for and how high of a price they sold for, and whatever market you're in, you need to take into account a buffer of a margin so that just in case something goes south with your deal, which it probably will, just because of the way real estate works, there's so many moving pieces, there will be something that's not going to be to your expectation, and you need to account for that with your workup of the deal. So even if there's a mishap, you can still turn a profit, or at the very least break even. Now again, for the purpose of this video, I want to show you guys how the place turned out. I think I talked about it a little bit in another video when I was actually in SF seeing the property, but these are some of the photos of the after and how it turned out after the rehab. And frankly, it turned out very nice, and it would have been okay had it been way under the budget that we came up with in the first place, but here we are today, and there's not really much we can do about that. Now for the final numbers breakdown of this property, I do want to tell you guys exactly how much it costs to acquire the place, then to do the rehab, and then actually to exit, as well as the exact figure for the net loss. So I can contextualize a little bit when I go through the mistakes in this next segment about what I would have done differently and things to look out for if you're doing a similar transaction in your neck of the woods. So the easiest way to break this down is that the total expenditure out of my own pocket at the end of the day was $81,000. The total remaining costs from the sale of the property is $65,000, and there's a $15,000 disbursement, give or take, from the sale of the property. So that's basically the proceeds to the seller, which is myself, which leaves a net loss of $131,855. So that's more or less a rough figure. There's probably more of a net loss than that, but that's basically what the gross margin is in the red from the purchase and sale of the property from start to finish. Again, this is the simplest way to break this down. There's so many other ways you can calculate the time value of money lost during the transaction, specific holding cost items that I didn't actually include. I didn't include utilities every single month and a couple of different change order things. But more or less, this is the figure of the total net loss on this property, which is $130,000, give or take, for this real estate investment flip that did not quite flip properly. Now, to get into some of the mistakes that I think would be useful for you guys to know and things that I might have done differently had I done this over again. The first one would have been not to necessarily trust your realtor or even a team or whoever you're working with on this deal, especially the person that has sourced the deal and brought it to your attention and made you aware that this is, a possibility for a good real estate investment. It is your job and your job only as the investor to vet it and make sure the numbers match and the numbers work out for the deal so that you're able to turn a profit at the end of the day. I have no personal issues with my realtor. She's a great person, and I think maybe that she just didn't really know much at the time, but this was definitely not a good real estate investment from any perspective from the start of this deal. Again, I'm not throwing anyone under the bus here, and I do think that it is my sole responsibility as an investor to make these decisions on my own and do my own research to make sure that what it seems is actually the reality. I think at the very beginning of the deal, my realtor sent me like a really quick workup of what the exit opportunity could look like based on the margin that, based off of the comps at the time, what it would look like with the possible rehab, and then what it would cost to make the sale at the end of the day, and the total margin in between. I think certain things weren't necessarily accounted for there, and pretty much a false expectation of what to expect with this real estate investment. And so something that I definitely should have done is run the numbers on my own with some margin of error, so that in case all the things that I'm about to get into did happen, I wouldn't be left holding the bag like I am now. So don't put too much trust in people. Don't trust your realtor 100%. Don't trust anybody, really. Nobody can be trusted these days. And especially with investments like this and trying to hedge your bets, it's definitely not good to place all your eggs in one basket, especially when trusting a singular person and not doing your own research before you jump into a deal like this. So the second mistake, or major issue I would call it wasn't really a mistake on my part necessarily, is that the HOA approval for the work on the condo was a very painstaking process that took way longer than any of us expected it to during this project. So I'll give you guys a quick timeline of how this whole project worked, right? So I purchased a place, I think December of last year, or maybe January of this year. I purchased it at some point last year around this time, right? And so basically the work was supposed to start within a month of purchasing the property at the latest, right? It was ready to go, nobody was living in it. We had all the contractor stuff ready to go, and the materials selected. We just needed to actually start the work. Now the problem is that the HOA changed during the time frame I was closing on the property. So with the old HOA that we'd done our research on and talked to make sure it was okay to do the renovations, they were a lot more relaxed and didn't have any major issues with specific little things with renovating a property, especially in an HOA, where they can place restrictions on pretty much anything. Not only did the HOA change, but once the HOA property management was changed, they actually raised the fee every month from $650 a month, which is already pretty high, to $810 a month. Can you imagine? I've been paying an HOA fee of $810 a month. I'm pretty sure that's more than what I paid for rent during my last year of college, which was only, 2 to 3 years ago. And I didn't see myself ever paying more than $700 on rent, and here we are. I was paying $810 a month just for the HOA on this damn place. Anyhow, we had the San Francisco DBI, which is the Department of Building Inspection in San Francisco. Those permits were already pulled, and we submitted them to the HOA with our scope of work, the proposed plan, the floor plans, what it's gonna look like, and it just took forever. Not only was the communication poor, but this whole process was just slowed down by a bad property manager. So many people were bad on this job that I could talk about. But again, not throwing anyone under the bus. This is something that I should have known and done my research on during the closing process, that I should have been aware of, that the HOA was going to change. And worst case, I'll lose my earnest money deposit, but at least I wouldn't be losing 130 grand like I am today, right? So again, lessons learned. The HOA approval, especially in condos, do not let that slip. Make sure you pay attention to who the HOA is, actually talking to them before you purchase the property, and don't have an expectation that you're gonna be able to get the work done in a month just because it's a 1 bed, 1 bath, 600 square feet unit. Even with the permits pulled, the HOA does have to do their inspection and fully approve the entire application process. And for me, it took from December last year until I think May of this year was when we actually started the project. So it was like almost 5 months for the HOA to actually approve the work. And as you guys probably know, the Fed started increasing rates back in, I believe, February or March this year. So had we flipped this place a lot sooner, one, the comps would have been better, and two, we probably could have sold it for a much higher price, given that the demand was probably still there, as opposed to where I'm selling now. It's a much lower price than I would have hoped, especially with regards to the ARV and where the market is and the interest rates and everything. So HOA approval, just don't overlook that, especially with a condo. I can tell you for a fact that I'm never going to purchase another condo for that reason. The HOAs I just cannot deal with, especially with a high of a fee as it is, with no amenities, is just, I can't justify that cost, even with a renter in there, you know, paying market rate with the HOA fee that I get no amenities. It just doesn't make sense. So number 3 is the contractor choice. Now there's a lot of videos on YouTube about how to choose a contractor, and you should definitely go watch all those very informative videos about how to do that, especially on Bigger Pockets. I'm sure if you guys are real estate investors out there, you've probably seen some of their videos and they're pretty informative, but definitely do your research and get multiple bids from different contractors. So the contractor I used on this investment property was definitely not a great one by any sense of the word. And I would say because it was an internal contact that I had, you know, someone that I knew could get the job done for a much more reasonable price than a lot of other contractors out there, especially in San Francisco where the work is just so much more expensive. When I compared quotes of my property in Texas with my one in San Francisco, it's a completely different world. Let me tell you, the prices are just ridiculous for just getting a basic kitchen remodel, you know, cabinets, countertops, stuff like that. It'll run you like 30, 40 grand just to do that. I would say that definitely look for a contractor that does have positive reviews, and just know that you will get what you're paying for. I think I've talked about this in a previous video, and I need to start working on following my own advice. Every time I've cheaped out on something within the past year or two, especially with this property, I've massively regretted it. I would say that's especially true with a contractor, because when they have poor craftsmanship, that's probably because they're not getting paid enough. Think about it, if you're a contractor out there wanting to get good work done, if you're not getting paid market rate, or if you're not getting paid as much as what you know your competition is getting paid, you're probably not going to do as good of a job as you probably could. Now, of course, you're probably not getting paid as much also because your work isn't as good as those other contractors, but you know, this is a chicken and egg kind of thing. As an investor, just don't cheap out on a contractor. That's the bottom line. Pick somebody that's vetted, that your friends have used, other investors have good things to say about them, and you know that they're trustworthy and can get the work done in a timely manner and have great communication with you. My contractor did not have good communication skills, not talking about a language barrier, but I mean, just did not communicate very well in terms of returning my calls necessarily. There was times when I was expecting work to be done and it did not get done. That's another thing. Make sure that you're actually checking in on the property every now and then. If you're having a project done on your own home, you would probably want to check on the status of it every now and then. The exact same goes for an investment property. If you hire someone to do work in an investment property and you're never there, think about it. They're gonna think they have all the time in the world because you're never physically there to actually check on it. Again, that's your job to make sure that you do that so that your contractor doesn't slack off and go work on other projects, which might be higher priority because the person is physically there, constantly asking for things, checking up on it, and making sure that things are all good. Anyway, long story short, the craftsmanship was just very poor. And if you guys out there have seen some of my other videos, I did a lot of the rehab, or if you want to call it rehab, or renovations on my property in Texas myself, and I care very much about craftsmanship and making sure things turn out nice. I'm into cars, and every car that I've worked on, I've detailed fully, done ceramic coating, you know, compound polish, paint correction, stuff like that. So I very much pay attention to detail, and I think a lot of people that are in real estate probably do as well. So definitely pick someone that you know has good craftsmanship and will not mess about and finish your place in a way that you wouldn't yourself. Now the last mistake I would say is pretty broad, but this condo is not fundamentally a property that I would purchase if I were not purchasing as an investment. And I think moving forward, the way I'll approach, especially investing in real estate, is that I'm really gonna try and focus on not purchasing any places that I wouldn't physically wanna live in myself. Now I get that the area that I was in definitely probably would have been useful to have a place in San Francisco or in the Bay Area just because I travel there for work. Whether or not I wanna go there is another thing. Again, not purchasing a place somewhere that you wouldn't wanna live in yourself, because at the end of the day, if for whatever reason you can't rent it out or you can't sell it, you're gonna have to hold on to the property until the demand comes back. And if you personally don't see yourself living there, or it's not a safe area, it's not a place that you could see yourself living, or it's just not a nice place without renovations and you couldn't see yourself living there, then don't buy it. At the end of the day, real estate is something that you take full ownership of, And until you find a buyer to take it off your hands, it's going to be yours. And so that's just a piece of advice that I have that I would say you probably want to think about before purchasing a property, especially in an area or for a price that you wouldn't find comfortable with paying yourself if it wasn't an investment. So bottom line, I want to just touch on some of the takeaways from this entire transaction and what I've learned from it overall. The first one is that house flipping is a very risky investment strategy and something that I'm probably not going to pursue in the near future. Again, as I touched on earlier, you cannot predict the market. And so if anything happens like in 2008 or with rising interest rates and whatever just happened in the last year, those are market conditions that are out of your control. And unlike other equities like stocks and bonds where you can just sell them, you can't sell real estate unless you have a buyer that's willing to pay the market rate or what you think or are expecting for the property sale. Now, I think my real estate investing strategy is going to be focused a lot more long-term, especially on rentals, whether it's with fixing up a place and then renting it out, doing cash out refi, something like that, or just buying a turnkey rental, turning it into a nice Airbnb, whatever the case might be, especially in an area that I would find myself willing to live in if it doesn't rent out itself. The second key takeaway for me is really that I'm not going to trust my realtor every single time, okay? I've also been a realtor and I just recently made my license inactive, but I was a realtor here in Texas and I will tell you that it is not that hard to get your real estate license, okay? Just because you're a realtor doesn't mean that you have the knowledge and background to make sound investing decisions for someone, especially to make recommendations of what's a good real estate investment versus what's not. Now, when I go to the doctor, do I trust what my doctor has to say about my medical conditions? Probably. But that's also because they've gone through 10 plus years of medical education, both undergrad, post-grad, getting their medical degree and then doing residency. All of the stuff that goes into that gives them the pedigree they deserve for me to trust probably whatever they would say in a medical context to a certain degree. Now, the same cannot be said about realtors, and the unfortunate fact of it is that it's very easy to become a realtor and not every realtor is a good one. So moving forward, even if I do have a great realtor, I'm gonna do my own due diligence and make sure that I don't trust my realtor 100% just because and they're supposed to give me advice based off their client's best interest. Now, the third one, which I just said, is do your due diligence. I think a key lesson learned here is that you can't be lazy in any step of the process with any investing strategy, especially with real estate, because it is such a complex machine of different moving parts that are involved with the purchase, rehab, and sale of property that you can't overlook any of them. And especially in the beginning, before you get yourself into this whole mess, you need to run the numbers and make sure you give yourself enough of a margin in case something happens. That's something that I frankly didn't do enough of. I did run some numbers and it made sense with the comps at the time, but that didn't give me enough of a margin buffer in case what happened did happen. And so that's how we got to where we are today. And moving forward, if I ever do flip a house again, I'm gonna make sure that I run the numbers extensively in many different scenarios and use cases with different market conditions in case something doesn't work out, that I have enough of a risk mitigation if something happens out of my control. Now, if I were to give a recommendation right now, whether or not I think real estate investing in terms of flipping houses is worth it or is too risky, I would say 100% don't flip a house, especially if you've never invested in real estate and this is your first time making a real estate investment, right? I would definitely recommend a rental of some sort, whether it's buying a place and fixing it up and then renting it out, or just buying a place that doesn't need much work, renting it out, finding tenants. That in itself is pretty tough to find the right tenants and do the tenant screening process. And so there's a lot to learn with multiple types of real estate, but I would say flipping a property is something that requires a lot more experience, and you need really good people on your team, everyone from your realtor to your contractor to even the escrow people, to make sure that the job gets done right, so you're not stuck in a negative equity position like I am today. Now, I know with all the investing advice out there, especially with real estate on YouTube or other social media platforms, or anywhere online really, even books, I would say that sticking to your principles regardless of what changes in the market or the conditions of your interests, the different areas, different geographical areas and things like that. I would say that if you have a principle, whether that's with a specific gross margin, right? If you follow the 15% rule, then stick to that principle regardless of market conditions. Don't think that, oh, this deal is so good that I'll follow the 5% rule, or my margin percentage doesn't really matter because this is a really good deal that I can't pass up. Don't let that get to your head, and don't be emotional with investing in real estate. I would say always stick to your principles. If it's the type of property, if it's a certain square footage that you're comfortable with, if it's a type of property in general, so like a single family residence versus multifamily, things like that. You definitely want to be comfortable in your investing decisions and be grounded in all those decisions that you make. And a lot of the success or failure you're going to experience, I think, is tied into what you hold as principles of investing. So what you believe are truths, regardless of market factors or specific investing opportunities. So my outlook for this one is that in the near future, I'm not going to invest in any more real estate in terms of a flip. My intention is going to be focusing on more long-term rentals, fixing up places that need a little bit of work and then renting it out and things like that. I definitely do need to dig myself out of this hole and build up my equity position again, even if I want to consider purchasing another property. That being said, drop a like down below, comment if you guys have any questions, and hit that subscribe button if you enjoyed this content. I definitely will try to keep being real with you guys and post the most updated content with what's going on in my life and share with you guys what I think is some valuable experience that I wish I would have had going into whatever situation that I've gone into in the past. As always, I hope you guys enjoyed this video. Thank you all for watching, and I'll see you all in the next one.